Welcome to the deep dive. Today, we're looking at something pretty interesting, a set of earnings materials that, well, they throw up a bit of a puzzle.
Yeah, sure.
We're diving into IndusInd Bank's Q2 FY26 results and the headline. A big private bank actually reporting a net loss for the quarter ending September 30th.
Yeah, that's the kind of thing that gets attention immediately. A consolidated net loss of, what was it, 437 crores?
Exactly.
You see that, and you have to ask, okay, what's going on here? Is this, a sign of real trouble, or is it something else?
Right. Is it a crisis, or maybe, just maybe, a calculated move by the new leadership? That's our mission today.
Especially when you compare it to last year, right? A profit of over 1,300 crores then versus this loss now.
It's a huge swing.
Yeah.
So we need to get past that headline number and really figure out why management decided to, well, take this kind of hit.
Look for the story behind the loss. Is the underlying bank still strong?
Let's start there. Where did this loss actually come from? Because as you hinted, maybe it wasn't the core business itself crumbling.
Okay, so the big number, the main driver, was provisions and contingencies.
Right, the money set aside for potential bad loans. And these weren't just up a bit, they were...
They were huge, up 45% compared to last year, landed at 2,631 crores.
Wow.
Taking that level of provision in one go basically guarantees you're going to report a loss.
Yeah.
Well, it's pretty aggressive, signals a major cleanup effort.
But the bank's management, they've been pushing back a bit, pointing to a different metric, saying the core is okay. What's this core PPOP they're talking about?
Yeah, core pre-provision operating profit. That's key. It's the profit from their main banking operations before you account for those big provisions and taxes.
And that was...
They highlighted that it stayed stable compared to the previous quarter, around 1,940 crores.
Stable. Is stable good enough right now? I mean, does it suggest the engine's okay, or maybe just idling while others are growing?
That's a fair point. I think you have to see it in context, given they were doing this massive internal surgery, especially pulling back on microfinance.
Which we'll get to.
Exactly. And treasury gains were lower, too. So maintaining that PPOP level, it does suggest the core parts, like corporate banking, vehicle finance, they were still ticking along quite nicely.
Okay, so the core operating engine didn't seize up despite the hit.
That seems to be the message. They absorbed the provision shock without degrading operational efficiency.
But speaking of hits, net interest income, the bread and butter, that did drop, down 18% year-on-year to 4,409 crores. Is that just part of the cleanup cost?
Largely, yes. Management directly linked it to intentionally shrinking the microfinance book.
So conscious choice. Less risk, but also less immediate income from that segment.
Exactly. They prioritized de-risking over maximizing NII in the short term. That's the trade-off reflected there.
Okay, so they swallowed this big loss. How's the foundation looking? Can they actually afford this kind of shock treatment without jeopardizing things down the line?
Structurally, they seem quite solid. Their capital adequacy ratio, CRR, is at 17.9%.
Which is well above what's required.
Comfortably above. And maybe even more important for stability, their liquidity coverage ratio, the LCR, averaged 132% for the quarter. That's a very strong liquidity buffer. Right. It means they can handle shocks, regulatory changes, and, well, decisions like this big provision dump.
So the foundations are strong enough to withstand the tremor.
Right. Now let's talk about that microfinance piece, because that's really the heart of this quarter story.
The epicenter of the shock. It feels like the new leadership came in and decided to, well, prune this part of the business very sharply. What was the thinking?
It looks like a deliberate strategy from the new MD and CEO, Rajiv Anand. It seems he didn't want this long tail of stressed MFI loans dragging things down for ages.
So get the pain over with quickly.
Exactly. Force the recognition of the MPAs now, take the hit, clean the slate, and then you can focus on the new strategy without this legacy issue constantly popping up.
And the scale of the write-off shows they were serious.
Oh, absolutely. 1,579 crores of MFI loans written off in just this one quarter. It is. And look at the loan book itself. It shrank by 25% compared to the previous quarter, down to 21,321 crores.
The 25% drop, quarter on quarter. That's not gradual pruning, that's
a major strategic shift, moving away, it seems, from a previous high-growth, maybe higher-risk approach in MFI.
Now, I gather new loans turning bad, the slippages, are still a bit high in MFI generally because of pressures across the industry?
That's right. It remains elevated.
So if the environment is still tricky, how are they trying to make sure they don't end up back here, needing another massive cleanup in a few years? How are they future-proofing?
They talked about overhauling the process, making it more robust to, quote, weather subsequent cycles.
Okay, like what specifically?
Things like doing detailed income assessments for borrowers and adding additional voter ID checks for every loan.
Additional voter ID checks. Sounds simple, but does that imply maybe the old ways weren't rigorous enough? A shift towards more central control?
It certainly suggests a tightening of standards, perhaps moving towards more standardized, centrally governed processes rather than relying purely on local assessments, which can sometimes be, well, less consistent.
Makes sense. What else?
Strengthening internal audit for better oversight, and crucially, setting up a dedicated collections team just for the older, overdue accounts, the 90-plus days past due.
Focusing firepower on the toughest recoveries.
Right. It shows a priority on resolving stressed assets quickly, not letting them linger.
And they're using external help, too. Credit guarantees.
Yes. The CGFMU scheme, the credit guarantee, they mentioned that 22% of their standard MFI book is now covered by this.
So that acts like an insurance policy for a chunk of the portfolio.
Essentially, yes. It cushions the blow if those loans face stress in future cycles. It directly addresses that volatility concern.
Okay, so the MFI situation is, well, it's been dealt with quite brutally, it seems. If we sort of mentally set that aside now, how does the rest of the bank look, the overall health?
It's a much better picture once you look past the MFI cleanup. The strategy seems to have worked in terms of isolating the problem.
How so?
The overall gross NPA ratio actually improved slightly from the previous quarter, down to 3.60%. And net NPA, which is after provisions, improved more noticeably, down to 1.04%.
Okay, 1.04% net NPA. And the provision coverage ratio, the safety net.
That improved too, up to 72%.
So for you listening, a 72% PCR means for every rupee of bad loan they have, net of collateral, they've already set aside 72 pays to cover it.
Exactly. And that improvement is the direct result of taking that big provision hit this quarter. It leaves the ongoing balance sheet significantly better protected.
Right. Let's check on the main business lines then. This is where the underlying strength should be, right?
Yeah, absolutely. Vehicle finance, that's big for them. 29% of loans. They called it a key pillar. Asset quality looks fine. Benign was the word used. And an interesting point. Their net slippage improved more than gross slippage. Why? Because they're choosing to handle more collections in-house instead of just selling bad loans off to asset reconstruction companies, the ARCs.
Keeping control. Shows confidence in their own team's ability to recover money.
It does. Then you have the corporate bank. That's the biggest chunk, 40% of loans.
How's that looking?
Very healthy. Negligible net slippage. Their focus is on mid and small corporates, and they said 77% of that portfolio is rated A or better. So good quality credit there.
Seems solid. Even the smaller, sometimes trickier segments.
Yeah, like gems and jewelries, which is only 3% but can be volatile. They reported strong collections and, importantly, no SMA-1 or SMA-2 customers.
And SMA-1 and 2, those are the early warning signs, loans just starting to show stress.
Correct. Special mention accounts. Having zero in those categories in a sector like jewelry suggests they're really on top of monitoring that portfolio.
Okay, so the picture is balance sheet scrubbed clean, core business is performing well. Ready for the next chapter.
Seems so.
Which brings us to strategy. The new leadership isn't just cleaning up, they're setting a new course. What's the big financial target?
They've put a clear medium-term goal out there. Achieve 1% return on assets, or ROA.
1% ROA. That's quite ambitious in banking.
It is. And to get there, they recognize they need to, well, diversify. Build strength in areas where they've historically been less dominant. Reduce that reliance on MFI and vehicle finance to smooth out earnings volatility.
So where are they looking to grow? What are the new frontiers?
Two main areas highlighted where they feel they're currently subscale. First, the MSME space, micro, small, and medium enterprises.
Okay.
Second, more traditional retail lending, things like home loans, affordable housing, gold loans, even agri-financing.
Right. Now, home loans, that's interesting. They're typically lower margin than, say, MFI loans used to be. So pushing hard into lower margin areas, doesn't that potentially make hitting that 1% ROA target harder?
That's the really fascinating strategic point here. They actually said they plan to scale the home loan book. It's about 5,547 crores now, irrespective of the cost of funds disadvantage.
Irrespective, meaning even if it's less profitable on its own. Why?
Because, they argue, it's crucial for building the liability franchise.
The other side of the balance sheet. So home loan customers tend to bring stable, low-cost deposits with them. Checking accounts, savings.
Exactly. Sticky CASA, current account, savings account deposits, that's the holy grail for banks because it lowers their overall funding costs.
So they're almost using home loans as a loss leader, or maybe a subsidy, to acquire cheap, long-term funding.
That seems to be the play. A long-term strategic move to make the whole bank cheaper to run, even if that specific loan product isn't the highest yielding, it stabilizes the funding base.
And technology must play a role in enabling this kind of scale-up in retail.
For sure. They mentioned good momentum on their digital platforms. The Indie app apparently has over 5 million registered users now. And Indie for Business saw its monthly active users jump 122% just in the last quarter. So digital is clearly key to reaching these new customer segments efficiently. #outro.
Okay, let's wrap this up. So what you, our listener, hopefully got from this deep dive is a look behind that stark headline.
Yeah, that net loss of 437 crores wasn't the whole story.
Not by a long shot.
Q2 FY26 was really defined by a deliberate, if painful, management decision. Accelerate the MFI provisions, take the hit now.
And the result? A much cleaner balance sheet. You saw that net NPA improved down to 1.04%.
Right. It clears the path for the new strategic focus, diversifying into MSME and those traditional retail areas, all aimed at hitting that ambitious 1% ROA target in the medium term.
So this episode gave you that more nuanced view. This wasn't necessarily financial failure. You could see it as a cleansing quarter, maybe a sign of decisive new management.
But that strategic pivot does leave us with a final thought for you to chew on.
Okay.
Given that they're explicitly saying they'll push hard on lower margin products like home loans, mainly to get those cheap deposits.
The liability franchise play.
Right. Will that focus on stabilizing funding ultimately help or actually hinder them in reaching that stated 1% return on assets goal? Can they really chase both aggressive diversification into potentially less profitable areas and hit ambitious profitability targets at the same time?
A classic strategic tension. Something to think about.
Indeed.
Okay, that's all for this deep dive. Thanks for joining us.